Hello and welcome. You're watching KYC, Know Your Company. Today we're going to be talking about NTPC. And, just to kind of list down a few reasons as to why we are talking about NTPC today. First off, is we're going to try and assess whether this is a pocket of safety in this time of uncertainty. And there are plenty of them, at least at a global stage, and even more so domestically. Growth seems to be coming off in that sense, and it's a roll-on impact of everything that's happening globally. So is this that pocket which is domestic facing and looking better in relative terms? So that's point number one. Point number two, valuation. Is the risk reward fair at this point? So the opportunity size may be so, but is the risk reward therefore fair from an investor perspective? So this is the first reason why NTPC. The second one is valuation. Is risk reward fair at this point? Because it's not trading at its typical valuations or long-term averages. Can NTPC deploy fresh capital at high return ratios? This is my third question, and which I'd like to have answered. The fourth one is opportunity, whether it is, so opportunity is large is absolutely fair, whether NTPC is well placed to capture that opportunity, or whether there are other players in a better space to capture the incremental market share coming out of the opportunity size. The fifth one is, what are the risks like, including the risk of execution? Because if execution does not happen, Mihika, you might likely not see the kind of outperformance that we've seen over the last 5 years from the NTPC stock. So those are the 5 key factors that I'll watch out for where NTPC is concerned. Welcome, Mihika, by the way. Let's quickly start off with what NTPC does. Well, it's the largest power generator in India. It has the largest capacity for thermal power in India as well. It operates 92 power stations and has a huge capacity. 76 gigawatts is the total capacity that NTPC has. It's 17% of India's installed capacity, 25% of India's utilized capacity for FY24. So extremely large. And it's a very, very important company in that sense. If NTPC stops producing power, you'd likely see
a big demand supply gap.
6 hours of our air conditioner not functioning, and likely being that the country will come to a standstill. So something to keep in mind. The second one is with regard to how, so it's 82% coal-based capacity that it currently operates, 18% renewables. This may shift, and we'll talk about this shift as well as it starts to happen and as it starts to unfold. We'll talk about how we're expecting that to happen. They have 17.6 gigawatts of thermal capacity under construction. Mind you, a lot of this has started to come on stream because of the large power demand and the deficit that we are playing at, and expected to add 5.5 gigawatts of thermal capacity over FY25 to 27 as well. So that's something to look out for on the thermal side of things. But ESG, Mihika, everyone wants to go green, so does NTPC. They're going into renewables, they're going into, they already do hydro in a big way, but they also want to go nuclear. So talk to us about that.
So, their focus on thermal is going to stay, because as we know that we're going to need that round-the-clock energy as we transition to renewables. But the priority for future growth is renewables. They're targeting 60 gigawatts of renewable capacity by 2032. This compares to 3.5 gigawatts on a consolidated group level as of FY24. Majority of this capacity will be built and deployed separately by NTPC Green, which is also its listed subsidiary, and they have 10.3 gigawatts of renewable projects currently under construction. But this, apart from thermal and your renewables, they have other multiple growth levers. Up first, they have coal mining. They have 8 captive coal blocks, means it's owned by the group. 2 of them are currently in the development, but these 8 blocks combined have an estimated mining capacity of 86 million tons per annum. The next part is pumped and battery storage. We've recently seen battery storage being mandated in upcoming tenders by the government itself. They're targeting 8 gigawatts of pumped storage capacity by FY30 and beyond, and the subsidy has also issued battery storage tenders of 2 gigawatts of capacity. And lastly is nuclear storage. Now they're exploring building small modular reactors. A concrete announcement is expected in 6 months or so, and they started work on 2.6 gigawatts of nuclear plants. And it's key to note that NTPC has actually a JV with one of India's premier, nuclear capacity builders, and they already have a step in the door. But Harsh, let's talk about the KYC ratings.
Yeah, so first off, let's try and break down as to what are the metrics that we look for where an NTPC is concerned. We'll start off with an income statement, then we look at the balance sheet, we look at cash flows, we look at key ratios, and we look at capacity additions as well, because that's going to hold the key. So maybe capacity additions and how that plays out, because one is what they've done in the past, and second is what to expect in terms of capacity additions, which will impact the revenue going forward as well. We look at key ratios, shareholding, street cred, and street coverage, along with valuations. So we look at all of that and give you a quick summary on how we rate this company, and thereafter taking a view from Nikhil Nigania of Bernstein with regard to NTPC and with regard to some of the questions that we posed at the start of the show. Let's start off immediately with the income statement. Now, in terms of the growth itself, it's been fairly healthy. You're looking at FY22 numbers, which were roughly at 1.32 lakh crore in terms of top line. It's done that in the 9-month FY25 period. So the growth over the 3-year period has been fairly healthy, 17%. YOY, it's been slightly more tepid, 6%. But if you're looking at margins YOY, they've inched up a wee bit. While it's flat largely, but inched up a slight bit. 3-year margins have actually come off, and that's because of raw material costs and raw material power costs going up. So some energy-related costs have gone up, including costs for coal and fuel, and due to which you are seeing the kind of impact on PAT versus the growth that we are seeing on revenue, which is 17%, but PAT is just about a 12% growth. So we're going to give this a neutral, because what we want to see is a translation of mid to high teens growth on top line to translate to the bottom line. That's not exactly happened, and that's something we're looking for. So we're going to do or give this a neutral. But what's the outlook with regard to capacity? Because that will give us more perspective on how this top line number as well as bottom line number will evolve. Mika, talk to us about that aspect of things. How, what's capacity adding up to?
Yeah. So first, let me just give a short synopsis on how it's grown historically over the last 3 or 4 financial years. Group capacity has grown 14% to around 76 gigawatts currently versus 60 gigawatts that we saw in FY21. And now total capacity of over 76 gigawatts is what we're seeing on a group or consolidated level for an NTPC. And they have 30 gigawatts of capacity under construction. This is across thermal, renewables, hydro, all of these counters. Now, the group has 17.6 gigawatts of thermal capacity under construction, and this is expected to be completed in around by FY31-32. And what thermal capacity getting executed does is increases regulated equity, which has guaranteed returns for the companies. Currently, all their coal-based capacities are under the regulated equity model. It's expected to add 5.7 gigawatts of thermal capacity over FY25 to 27 itself. And in the renewable space, like I mentioned, 10.3 gigawatts of renewable energy projects are currently under construction. So the pipeline, whether it's their core business of thermal as well as renewables, which is where they're pegging their next level of growth coming in. It's a healthy pipeline, and it's a thumbs up on this run, considering historically they've grown their capacity at a good pace, and they have specific targets and a good pipeline to execute in the next over the medium term.
Very interesting. So that's on capacity. Let's look at the balance sheet now, because it's a PSU and therefore picks up funds from debt markets at extremely low levels. Your equity share capital, again, is decent-ish in terms of size. Mind you, this is a very, very large company. And just for perspective, I want to quickly pull out the equity share capital plus the reserves. That adds up roughly to around 1.7 lakh crore at the end of September of 2024. Of course, we don't have the full year FY25 number, but H1 FY24. So both equity plus reserves is roughly 1.7 lakh crore, but the debt, as you can see on your screen, is 2.4 lakh crore. So the borrowing number is extremely high. It's roughly paid out 13,000 crore in terms of interest payments in the last year or so, and therefore it funds its debt at extremely low cost of debt, which is again a key positive. It gets a sovereign rating because it's 51% owned by the government of India and therefore enjoys that, and its cost of borrowing is maybe 1% or 2% lower than most other players in the industry. For example, a JSW Energy who I spoke with just about today, or rather on Saturday, came out and told us that 8.8% is what they are funding their debt at. So this one is at a reasonably lower level to that, clearly. And that's the one big advantage that it has. But yet, the balance sheet size is very, very large, and the debt number is extremely large as well. And therefore, we'll give this a neutral. Risk is low, of course, of the debt on that balance sheet, but nonetheless, something to be mindful about. Cash flow, Nika.
Yeah. So what they've been investing so far and adding, it is translating into a good set of, cash flow. Now, if you look at the cash flow from operations, FY22 to FY24, we actually did see a slight moderation. But H1 FY25, which is what are the latest values that we have available, 67% of the cash flows from operations that they saw in FY24 has already been reached. And in terms of their net cash flow is where you've actually seen the turnaround. FY22, you had a negative balance of 274 crores. This kind of contracted to 210 crores in FY23. FY24 is when they went net cash flow positive at 398. And in H1 FY25, the net cash flow number stands over 1,200 crores, which is 3 times than what we saw as a whole in FY24 as a fiscal. So it's a thumbs up on cash flows. Whatever they've been investing has been, kind of fruitful for them, and we've seen the net cash flow number, which actually was negative 2-3 fiscals ago, turn positive and seen a triple growth in the first half of FY25 itself. So it's a thumbs up on the cash flows, Harsh.
Thumbs up on the cash flows. Okay, let's look at return ratios therefore, because once you have this kind of cash flow coming in, and the net cash flow number may not be the right metric to look at, Mika, here, because they're reinvesting a large part of their surplus. There's a power deficit in the country. They're pushing and trying to take advantage of that. And therefore, your net cash flow from operations could well be a minor negative or a very slight positive compared to the cash inflows from operations that are coming through. But the point, therefore, is return ratios aligning up. And what we're seeing is they're just about able to make early teens kind of return on equity. And therefore, is this a lucrative enough business is really the question. The other part also is the fact that traditionally this has always been the kind of range that they've operated in. So it's not, you don't expect a very large increase in this number.
That's true.
Also, a lot of the returns are pegged or are premeditated to a large extent, because you already have power purchase agreements which are locked in for 15, 20, 25 years, which kind of guarantee you cash flow, but at the same time lock in your return ratios as well. So the return on the regulated equity, which is generally the metric on which a power purchase agreement is signed and is decided upon, is largely 18 to 19%. So you will likely continue to see these kind of ratios last, especially in a high capex cycle, which we're just about entering, right, Mihika? Is that the right way to look at it? The other piece I wanted to explain is this regulated equity, this return on regulated equity. Wanted to take a minute to explain that concept.
Yeah. So regulated equity is basically something that is decided by the regulatory boards in the space. For NTPC, it ranges between 18 to 19%, and this is a guaranteed return on the equity capital base of the company. Now, usually when NTPC is setting up a certain project, they're not going to fund it entirely by equity. Obviously, they have a debt portion. We've seen that in terms of high debt, but it typically refers to the portion of a utility or any regulated entity's capital structure that is considered equity, and for the purpose of regulatory procedures. And it kind of gives some kind of predictability in terms of the revenue and profitability in how you can determine it for something like an NTPC. And more capacity they add, which is under the regulated equity model, the more their regulated equity kind of grows over the next few years. So capacity additions for the company's regulated equity to grow, and thereby your returns on equity to grow, is very important for something like an NTPC.
Fair point. And shareholding,
Yeah.
Nika?
So it is a PSU. We have the Government of India steady shareholding, 51.1% ever since March 22 till December 24. We have seen DII's kind of their shareholding in the company fall from 45% in March 22 to 26.76%. But this is on behalf of FIIs actually being more interested. We had no shareholding or any kind of stake in NTPC from the FIIs in March 2022. This stands at over 18% as of December 2024, and minimal retail interest, just about 4%, but we've even seen a slight uptick in that as well. So it's a thumbs up on a shareholding. You have government backing, DI as well as FI interest, little low retail interest, but you have exposure via mutual funds, etc., from your institutions.
Yeah, fully agree. I want to quickly highlight a few large shareholders here, Mika. So one, Life Insurance Corporation was a very large shareholder, a 10% shareholder, in fact, in NTPC. Currently holds 4%. So we've seen a dilution from an LIC. Who is adding? There's a Government of Singapore, very interesting, has hiked stake consistently over the last couple of quarters at least. So we've seen its stake go to 2.4% within that FII basket. So again, interesting here as to the fact that who some of the FIIs are and what are the DIIs also doing. So some moves happening on that count. Let's look at street cred and street coverage jointly. One, the 1 year performance hasn't been outstanding. The 5 year gains though have been really good. So we've seen a 281% return that the stock has given. It's been a multi-bagger over the 5 year period. In terms of valuations, currently at around 16.94 versus 5 year historical of 16.6. And I'm talking about price to earnings. Whether that's the right metric or whether price to book is the right metric. And in comparison to its peers, the price to book number is at a substantial discount, and hence you'll see a lot of analysts super bullish on this. Price to book is likely the better factor to look at it from a valuation standpoint. So street cred is largely a neutral. Valuations, we'll give it a thumbs down for the moment, but we'll get better perspective on how exactly should you try to, or how is the analyst community looking at this. The P ratio currently is at the highest seen in the last 7 fiscals, and that's where we're not getting enough comfort. Also, the dividend yield is just 2% when historically it's been higher. Cash flows are being churned back into the business. So some of those factors also playing out. But let's look at the cumulative rating on this one, and we'll summarize it very, very quickly for you on the screen. There you go. That's how it all stacks up. Income statement, capacity additions are going to be solid. Expect that to continue to come through. Balance sheet neutral, cash flow is positive given the fact that operationally we've been doing well. Return ratios is a neutral. Shareholding is a positive given there's enough comfort. Government holding 51 and DIFI holding is quite healthy. Street cred and valuations. That's how it's really stacking up. Let me quickly bring on board Nikhil Nigania, director at Bernstein, to talk to us about his views with regard to an NTPC. Welcome, Nikhil. I want to quickly, first off, try and understand straight up from you. This is a sector where the tailwind is extremely strong. Is NTPC well placed to capture the tailwind? It's been a very strong player in the space. Can it continue to do so, or are smaller players eating into its share?
Fair question. So NTPC has been one of our top picks in the sector for the last almost 2 years or so. So if you look at from a tailwind perspective, what are the tailwinds which are happening in the sector? One is power demand growth, while FY25 was a bit slow at 5% growth. Before that, 3 years power demand grew at 8-9% CAGR. Going forward as well, we expect 1x real GDP, which is about 6-7% growth in power demand, which is higher than historical, what we had in the last 2 decades. The second more important theme which benefits NTPC is the evening power shortage. So what is happening in India is we have enough power when the sun is out, but in the non-solar hours of the day, which is after 6 p.m. or even early mornings in winters, is when we have a power shortage. Now, to solve for evening power shortage, the obvious answer is a thermal plant. And NTPC is the biggest player in the thermal sector in India. The private sector was hesitant to add new thermal plants, and hence NTPC took a big lead in that. So the need for thermal capacity, which was effectively written off a few years back, is where NTPC stands to gain from the tailwinds. And to the question, so NTPC recently announced their plans to do 30 gigawatts of incremental thermal capacity by 2032, which is a substantial number on a current total base of about 75, 80 gigawatts of generation capacity that they have. So one is thermal story. Second, interestingly, is the renewable story. So as government pushes to add a lot of renewable capacity with an aspiration to reach 500 gigawatts of renewables by 2030, up from 220 today, NTPC, we think, will play a big role in that as well, even in the renewable story. Why do we say that? It's simple cost of debt advantage, which you were alluding to earlier as well. They can borrow money much cheaper than peers. And in a renewable business, which typically 75-80% debt funded, that can be a huge advantage for a player. So these two reasons primarily, the need for more thermal plants and the advantage NTPC has on the renewable side, is why we think NTPC continues to be a good player to own in the space.
Nikhil, you mentioned a lot of, thermal as well as your renewables, kind of, how NTPC gains from both of these stories. They have a lot of capacity, under construction, but execution is very key, whether it's in terms of your regulated equity getting higher. How do you expect their, consolidated capacity to grow in the next 3-4 years? Will execution be on time?
No, that's a fair concern. So the only concern we have to our thesis is execution. So thermal, there has been delays in plant commissioning, though quite a few of their plants are very close to commissioning, which should get done in FY26. But an even worrying trend has been renewables. So renewable also, they guided 3 gigawatts of renewable capacity addition in FY25, but we think they haven't even achieved half of that. So it's not just them. Most players have struggled to add renewable capacity against their guidance. But even for NTPC, execution has been slower than envisaged by us and the street, both on thermal and renewable. So going forward, thermal should improve. As I said, close to commissioning assets are there. Renewable also should get better, but again, their issues of land, issues of transmission could keep execution below their initial guidance.
Okay, and how should one look at return ratios therefore, Nikhil? It's a space which has been in focus because there are prolonged power shortages in India and has been the case over the last couple of years. We're expecting that shortage to continue as well. Shouldn't return ratios improve in such environments?
See, what happens in the power sector is in a power shortage situation, the ROE, the return equity of NTPC doesn't change, right? Most of their assets are regulated return assets.
Correct.
So they really don't get an upswing in the ROE due to a power shortage. The benefit they see is in the incremental capacity addition, which is why the capacity pipeline has expanded, growth has expanded, and the multiples have re-rated. Companies which gain in a power shortage situation immediately are companies which are merchant power capacity, untied thermal capacity. So those are the players which gain more. So NTPC benefits on the long term, not immediately in the near term. So the ROE of NTPC in our forecast continues to stay around 13%, which is their existing ROE, which they report at a company level. So it's not a ROE change which has happened. It's a growth inflection which has happened in NTPC over the last 2 years. And that to a long-term growth inflection, not really a near-term growth inflection, why the stock is related.
Got it. So it's a long-term growth story in terms of how, the capacity adds up. I also want to bring the nuclear power angle in it. We've seen the company kind of show interest in the small modular space. They have kind of exposure via their JV Ashwini. How do you feel this, story playing out, considering that we have a target and India aims to, kind of bump up its nuclear power capacity?
Yeah, so nuclear is the new focus from the government side. Again, the reason for focus on nuclear is the same challenge I highlighted earlier, which is how do we get power in the non-solar hours of the day? Other than thermal, one answer is nuclear. That's why the push towards nuclear. So nuclear, we admire the aspiration government has, and without a doubt, NTPC will play a key role. Till now, all the nuclear power plants in India were built by Nuclear Power Corporation. Going forward, apart from NPCIL, NTPC has also formed a joint venture with NPCIL to add nuclear power plants. So there also NTPC will gain, but again, the first nuclear power plant by NTPC will possibly come by 2032 at best, not before that. So it's a long-term story, not something which impacts the near-term earning. It's more a long-term growth inflection which nuclear would add. And on nuclear also, I mean, while it's a right ambition to have by the government, the challenge is execution. To build a nuclear plant in India, it takes 10 years or even higher for a greenfield plant. If you look at the Gorakhpur nuclear power plant we are building, it's a greenfield capacity. Construction started in 2018 and is expected to get commissioned in 2032. That is if we don't see further delays from here. So that's the kind of timeline we're talking about. So again, not a near-term story, but more a long-term growth impact on NTPC per se from nuclear side. And SMRs, again, we have our challenges. We have, reservations as well. Globally, companies have taken a long time even China took more than 10 years, and they are still not commissioned their SMR, which they are building. So it's again a long cycle. SMRs are a long-term solution to power beyond 2035 possibly, not before that.
Point taken. Nikhil, I'm going to wrap two questions into one because we're out of time, and I'd request you to be as brief as possible. One, how do you view valuations, therefore, for an NTPC? Of course, it's a PSU. There's some execution risk in any case, as is the case in most other PSUs as well, but more so in the power sector. That's point number one. Point number two, return ratios, should we expect that to be around the early teens or just about double digit? Is that the prolonged expectation as well, or can we expect a bit of a re-rating there as well?
Yeah, sure. So second question, let me answer first. So the ROEs, sure. I don't think will go significantly above 13%.
Okay.
See, renewable, which is again a big part of the growth. In renewable business, you don't make phenomenal returns. The returns are early to mid-teens at best. So ROEs, we expect to stay around 13% in the long term. On the first question on valuation, so the domestic market tends to look at NTPC on a price-to-book basis. Is currently at about 2x price to book, last filed. The private sector peers, if you see, are 3.5, even 4x price to book. So it trades at a discount to private sector players. Globally, utilities on price to book are around 2x. So it's not expensive even from a global standpoint. It's in line with global peers. And earnings multiple or EV/EBITDA is in fact at a discount to global peers. On EV/EBITDA, it is 9.5 times. Globally, utilities are at 10.5 times. So NTPC seems, fairly priced. It's not expensive as per us. And to play the power sector, we prefer an NTPC over the private sector peers it has due to this low valuation, due to the cost to debt advantage and so on.
All right, Nikhil, it's been comprehensive and it's been interesting. So thank you for coming in and speaking with us. Great getting your views and thoughts on this to try and, unpack this a little bit more. So thanks for that. But, frankly, out of time on this one. From Mihika, myself, everyone who puts the show together, thanks so much for watching. Hope this has been helpful. NTPC is what we've tried to deal with today. Stay tuned to NDTV Profit. More action on the other side.